Good afternoon, ladies and gentlemen. Welcome to the Lounges PLC Interim Results Investor Presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated in the right-hand corner of your screen. Simply click Q&A, scroll to the bottom, type your question and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company will review all questions submitted today and publish responses where it's appropriate to do so. These will be available via your Investor Meet Company dashboard, and you'll be notified once they're ready for your review. I'd also like to remind you that this presentation is being recorded. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Nick Collins, CEO, Gregor Grant, CFO of Lounges PLC. Good afternoon.
Good afternoon, everyone. Thank you very much for joining us. My name is Nick Collins. I'm the Chief Executive of Lounges, and welcome to our results presentation for the 24 weeks ending 3rd of October 2021. I'll go through some highlights and then a few more operational slides. Then I'll hand over to Gregor, who'll go through some of the financials. Then I'll come back to me and I'll update on the end in terms of current trading as well and Omicron, etc. But looking at slide 3 and the highlights, first of all, it's been another very strong financial performance for Lounges in the first half. Our market-leading like-for-like sales performance, it continues to reflect the relevance in our brands and our operational strength. And we've talked about it previously, but every time we've been allowed to open during COVID, we've consistently outperformed the market. And that's been the case this time with underlying like-for-like performance of plus 13.6%. We continue to have very strong EBITDA conversion, and whilst we are benefiting from the government initiatives, our cost pressures are well managed, and we've seen underlying margin expansion of 0.4% despite the inflationary pressures. We further reduced our net debt, and in the first half we opened 12 new sites. We opened 11 lounges and 1 Cosy clubs, and we've subsequently opened a further 5 lounges in H2, bringing the total estate to 185 sites today. So the presentation is actually slightly out of date. We opened a site on Wednesday in Gainsborough, and we expect to open 25 new sites now in this financial year. So looking at slide 4, and what we thought might be useful here is to have a few slides which set out why we continue to outperform the market so consistently, and perhaps explain why Lounges is so differentiated to the rest of the hospitality and the leisure sector. And this first slide looks at our broad demographic profile of our customers. So within Lounge in particular, we talk about serving everyone for every occasion. The business is ageless and classless. And a few key statistics coming out of that. So 61% of our customers are female. 90% of our customers visit for more than one occasion. And when you look at our ability to generate revenue across the day, that's really critical, that fact that people are visiting for lots of different occasions. Then looking at the donut chart there at the bottom of that slide, you can see an astonishingly even mix across all age cohorts of our customers. So you walk into a lounge and you're as likely to see students as you are grandparents and everything in between. And the Cosy clubs have a very similar demographic profile as well. Then looking at the bar chart in the top right of that slide, we've tried to talk about classlessness here. We'll try to demonstrate that, which is quite tricky. But what we've done is we've shown here the average earnings per week in each of the locations where we operate the lounges. And what you can see here is quite a normal distribution. What's really important about the lounges is that degree of affluence in a community doesn't have any impact on how our business trades. The lounges work as well in Warrington as they do in Wokingham. Then looking at the next slide 5, lounges and the lounges are very much a genuine all-day business, and that's what these charts speak to. So again, just pulling out some key statistics here. Looking at the top left and the sales mix and the week versus the weekend, 46% of our sales are generated between Monday and Thursday. And that's quite rare for a leisure business. Typically with leisure businesses, you'll see much stronger reliance on Friday, Saturday, Sunday, and particularly the evening trade and alcohol-led trade. But within the lounge business, we're generating revenue right the way across Monday to Sunday. Then looking at that middle chart at the top there, you can see our sales mix, 60% food sales and 40% drink sales. So really good balance there. And in the top right-hand side, you can see our sales mix by day part. So 19% of our sales are generated in the morning, 47% of our sales generated in the afternoon, including lunchtime, and 13% of our sales generated in the evening. It goes back to that point again. We're generating revenue right the way across the day, from 9 o'clock in the morning through to 10, 11, 12 o'clock at night. Then looking at the two bigger charts at the bottom there and just breaking down that sales and looking in a bit more detail about the drink side or the wet side and the food side. Looking at drinks first, so 59% of our sales are alcoholic drinks, albeit that's from a value point of view. On a volume basis, the non-alcoholic drinks dominate. They're just at a lower price point. 19% of our sales are hot drinks. So coffee in particular, really important driver of sales, in particular in the shoulder periods and early morning. And cocktail sales are 19% of our drink sales. That's a number that's doubled since during COVID. So pre-COVID, we were sub 10%. We're now 19% of sales cocktails. So there's been a real shift in the way that the customer's behaving there. And on the food side, again, you can see just looking at the chart, there's a very strong mix between lots and lots of different categories. We have a big food menu. We're not wedded to any particular cuisine. We serve that same menu right throughout the day, from 9 o'clock in the morning through 10 o'clock at night. Brunch sales representing 26% of our sales. So I said in brunch, we've seen a lot of growth in recent years and in the shoulder periods. Burgers at 19% of our sales are a very important part, but they don't dominate too much. And we still generate 14% of our sales from what we call our classic mains and 11% of our food sales from tapas. And we like tapas because we want to encourage people to share their food. And then slide 6. What we're trying to do here is take some of those dynamics and look at them in respect of a specific site. And here we're looking at one of our lounges, Trego Lounge in Portswood. And worth just I'd say Portswood's a suburb of Southampton, just on the east side of Southampton. Thinking about Southampton, we also have a lounge in Shirley, which is a suburb to the west, on the western side of the city centre. We've got a lounge in the southern part in Ocean Village called Maritimo Lounge. And then we're opening a lounge in the Isle of Wight next summer. And we'd love to open a lounge in Eastleigh to the north of Southampton as well, but we just haven't found the right opportunity there yet. And I think that really helps demonstrate how the lounges are located. The suburban lounges tend to cluster around cities, in the suburbs around cities where there are lots of chimney pots. So looking at Trego Lounge, that opened in October 2009, so it was about our 14th site, so quite an old one, and it's a good performer. It's in our second quartile sales group, and it's achieved LTM EBITDA of 320,000. Total Capex that's been invested in the site in its 12-year history is 631,000. And worth noting that this, obviously, it's quite an old site and we don't build them at that low cost anymore. Average Capex for a lounge now is around 675,000. And that's just to open the site. Now, if we consider the competitive landscape in which Trego Lounge operates, looking at the map here, you can see Portswood High Street. And this is a really typical lounge high street. It's the kind of arena within which we trade. You'll see some retailers, the likes of Poundland, Boots, Card Factory, Post Office, probably one or two banks, a couple of supermarkets. And then from a leisure perspective, there's a Coffee One, there's a KFC, there's a Subway. We trade alongside a Green King pub called the Mitre. And as I said, that's very typical of the type of environment where the lounges trade. And if you think about, if we come and open alongside a pub or a coffee shop or a sandwich shop, we're competing with everything that business does. Whereas if they come and open up alongside us, they're only competing with a very small element of our sales. And thinking more broadly about Southampton, we're about two and a half in Trego Lounge here. We're about 2.5 miles from the centre of Southampton and the West Quay shopping centre. And that's probably the retail and leisure hub of Southampton. And there you'd find a number of very well-known casual dining restaurants. You'd also find lots of the bigger retailers. And in thinking about the potential scale of the lounge business, I think this is really helpful, because if you think about those casual dining businesses, they wouldn't be able to open on Portswood High Street. They wouldn't generate sufficient revenue. Whereas the lounge model there, servicing a very, very broad demographic, servicing all the day parts with a really broad menu, we're able to generate revenue right from 9 o'clock in the morning all the way through to 11 o'clock at night. And that allows us to generate strong returns on capital on low rents in locations which have relatively small populations. Keeping with, I've clicked on to slide too many, I think. Here we go. Apologies. Slide 7, and this looks at another really important concept or principle within our business, which is value for money. Throughout our 20-year history, we've shown great pricing discipline. And whilst there have been opportunities in the past to take price, we've always wanted to maintain a really strong value for money position. And what we've done in the last few months is we've undertaken a price comparison exercise. So in 14 locations in the UK where we trade, we've gone out and we've looked at all what we think are the relevant competitors, and we've recorded their pricing. And then we've measured how our pricing compares alongside these other operators. And we're doing this for 2 reasons. I think firstly, we want to reassure ourselves as to how we compare now from a value for money perspective. But equally, our sense is that we're moving into an inflationary environment where lots of other operators will be putting up prices. And if that is the case, we want to make sure we've got a really good understanding of the gap between us and others. And if that gap is broadening, that clearly presents us with opportunities. What we can see in this chart here is that Trego Lounge on the drink side, so the 3 columns on the left, is better value for money than most of our competitors, not by a necessarily significant margin. And then on the right side, you can see on the food side, we probably represent slightly better value for money. And that's, I think, what we would have expected. Earlier this year, we introduced banded pricing for the first time. Prior to July of this year, all the lounges across the UK had the same price points on one menu. In July of this year, we introduced banded pricing and splitting the sites into 3 different bands. And that's given us more opportunity from a pricing perspective. And Gregor will come on to talk about that shortly. So looking at slide 8 and just revisiting the concept of all-day trading, and then looking at perhaps in the context of Trego Lounge, which we've been discussing. So that top chart there shows average weekly sales per hour. And what you can see there is that Trego Lounge is generating meaningful levels of revenue right from 9 o'clock in the morning all the way through to 11 o'clock at night. And that's very typical for what we see for all of the lounges. Then looking at the slide, in the chart in the bottom half, you can see Trego Lounge's like-for-like sales performance over the last 8 years. And this shows what we would expect: year-on-year, volume-driven, like-for-like sales growth. You can see there are 2 years where we were in slight decline, and I don't know the precise reasons, but that might have been for a number of reasons. We might have had the wrong general manager in place. We might not have. One thing that Trego Lounge is one of a small number of lounges where we actually have quite a strong student population living around the lounge. One of the things we've learnt with student populations is that if we don't get it right in September and October, when you get a new set of students, then you might have lost them for the year. Then you have to work really hard the next year to get them back. So that might be what's happened there. But we want to generate that consistent year-on-year, like-for-like volume-driven growth, and we do that by focusing on hospitality, focusing on atmosphere, focusing on our involvement with the local community, and most importantly, continuing to innovate and evolve and make sure that our proposition is as good as it possibly can be. So I hope in those slides I've been able to set out and demonstrate why the lounge model is a very different proposition to what you might be more familiar with in terms of casual dining restaurants or pubs. And then moving on to slide 9, and the next few slides just cover a few areas which are where we focused a lot more recently. The first one looks at Cosy Club evolution. And we've undertaken a really big project elevating the customer experience at Cosy Club. and that's included a full reworking of the menu. I guess understanding why have we done this? I think what we saw an opportunity to be better. We wanted to be a little bit more aspirational. And lockdown 3, so at the start of the year, we had a few months where we were given the opportunity, we were given the time as a senior team to really focus on menu development. And that's time that we might not otherwise have had. So we've introduced 40 new dishes to the menu, slightly elevated, a little bit foodier. We've introduced the concept of small plates. We want to encourage people sharing. We've reworked all the recipes on the menu. That's not dramatic change in a lot of them, but it's just challenging. Can that ingredient be better quality? We've reduced the dish count, and we've also reduced the number of SKUs or ingredients that we have in our kitchens in the Cosy Clubs from 250 to 180. And that really allows us to introduce more simplicity, more consistency from a margin and yield management perspective, and quicker ticket times in terms of getting the food out to our customers. We've also introduced new point of sale materials, featuring some really cool Art Deco designs, and we've introduced new furniture across all of the Cosy Clubs, more kind of fitting our beautiful interiors. And the furniture that we've removed there will go back and will be refurbished, and it will go back into new lounge openings. And we've also enhanced the customer journey through improvements to our steps of service, just to make sure that we're really giving the customer lots and lots of attention. And we trialled these changes in 5 Cosy Clubs throughout the summer. And we were really pleased and encouraged with the way our customers reacted. And during October and November, we've rolled out these changes across all 31 Cosy Clubs. Next slide, slide 10, and just thinking about evolution on the lounge side of the business. And our kitchen revolution continues. This year, we've completed the installation of the kitchen management system screens that you can see in that picture in all the lounges in the estate. This means that instead of having paper tickets, which have the orders on for our kitchen teams, they can now see them all on screen. And what it allows us to do is it gives us great intelligence in terms of understanding how long it's taking from the from the time the customer orders their dish to the time it's delivered. And now across all our lounges, every day we can see where there are any problems, where ticket times are extended, and that can feed into our operational team, so they know where we need to focus more time from a training point of view, maybe we need more labor, or indeed in terms of menu development, if there are specific dishes that we've introduced which are taking a very long time for our kitchen teams to deliver. And this kitchen management system was one half of what we were calling the kitchen reset project in Lounge. The other half involves the introduction of new equipment and standardizing the layouts and the ergonomics of these sites to make life easier for our kitchen teams during peak of service. So we still have 61 sites to complete from a reset perspective in terms of introducing that new equipment, and we're scheduling that in now for 2022. Another area where the lounge business has improved, I think, really dramatically is in relation to insights and feedback. When we introduced the app as a result of COVID, we saw a massive increase in the amount of feedback that the business was receiving. So on the lounge side, we've gone from receiving 1,000 pieces of feedback a week to 5,000 pieces of feedback a week, which is a vast difference. And that's great because that gives us lots and lots of intelligence into what our customers think about dish-specific items. So where they think we can be better, what they like, what they don't like, etc. And we've recently hired a customer insights manager who's managing and summarizing all that data for us and really pulling out the key trends so that we can improve from an innovation and menu development perspective. Turning to the next slide, slide 11, and looking at build and property. And during the last few months, we've done a lot of work evolving the build and property team structure. So Tom Trenchard, who's our property director, he was previously responsible for the acquisitions and the property side of the estate side of the business. He's now additionally taken control of the build side, the construction side of our business. And we've introduced a new person, a new head of construction within the business, splitting the development side and the construction side. We've gone through these changes for a number of reasons. I think firstly, we want to future-proof our organisational structure. The construction side previously reported into me, and then having them report into Tom allows me more time to spend into the sites and looking at other aspects of the business. I think it will also allow us to challenge and manage more efficiently our Capex spend. I still think there's more we can do from a labour perspective and from the way that we schedule our jobs. And thirdly, having this structure will allow us to introduce a fifth build team when and if we feel that that's the right thing to do. And in terms of the pipeline, we've talked in the past a lot about how we're seeing really good pipeline opportunities, and that continues to be the case. It's a trend that we were seeing pre-COVID, and we continue to benefit from retail CVAs and see really excellent quality prime pitch opportunities in locations right across the UK. And that's reflected in the way that we're opening sites. We're opening sites very well, increasing the average level of unit EBITDA in the business. Looking at slide 12, and the last one from me before I hand over to Gregor, looking at people, recruitment and retention. And recruitment and retention within the hospitality sector remains challenging. It's been talked about quite a lot in the press. I guess some points around that. It's not everywhere. I think that's quite important. It was in Devon and Cornwall over the summer. It was incredibly challenging. What we saw was a real boom in demand as a result of staycation, and equally we saw that from an accommodation perspective, it's very challenging finding temporary accommodation for people living down there, which made the problem a great deal worse. And then in market towns as well, I think we found it harder. Cities and suburbs have been a little bit easier. Market towns have been a little bit trickier. Our sense, though, is the situation is improving a little bit. I think once we were out of September into October, the staycation kind of boom kind of eased off a little, and we saw students going back as well. I think that probably helped from a recruitment point of view. In terms of the impact this is having on our business, it's having a negligible impact on sales. There's one or two sites from time to time where we're having to either close early, just because we don't have sufficient team members. But that's not, as I said, that's not having a material impact on sales. It's quite negligible. And it's worth reflecting that we continue to open sites. As I mentioned at the start, we've opened 17 sites this year. And when we open a new site, we need to recruit a team that might be between 25 and 35 people to open and work in that site. And we're managing to do that, which would suggest that we are obviously finding people. I think what's really critical is that the situation makes it really tough on our existing teams. And our team have worked astonishingly hard over the summer, demonstrating real commitment to produce this fantastic trading performance. And for us, it's a really fine balance. We need to make sure that we're not asking too much of our team, else that exasperates the problem. And what are we doing? In the recent months, we've had a lot of engagement and consultation with our teams, and that will continue into the new year. I think it's really important that we address the root cause. And we talk about work-life balance a lot. One thing that's become clear as a result of COVID is that a portion of people who are working in the hospitality sector pre-COVID then went on lockdown and got exposure and experience in other sectors of the economy. And in some instances, they found that was easier, or they were able to work more sociable hours or less in a less stressful environment. And so I think that both as a sector and in terms of lounges as an employer, it's important that we recognise that, and that we need to introduce behaviours which will allow our teams to have a better work-life balance. We are investing in apprenticeships and it really increased our focus in terms of how we train our teams in the kitchens. And equally, we're shouting about what we're good at as a business. Given our rate of growth, we can offer amazing progression opportunities to people who want careers in hospitality. And equally, we're very good on share ownership. So that's it from me. I will hand over to Gregor now.
Thank you, Nick, and good afternoon. I think as Nick opened, it has been a very strong financial performance in the first half, but I think even more importantly, it's been a really strong underlying financial performance. And I guess as we've maybe got used to over the last 18 months, these numbers are once again impacted. For example, on the negative side, by the fact that the first 4 weeks of the period, we could either trade internally, externally only, or our sites were closed. And then throughout the period, on the positive side, we clearly benefited from government support measures, most notably the VAT reduction. So what I look to do over the next few slides is really try and explain the strength of that underlying performance, get beneath the headlines. Typically, I'm doing that by comparing our performance in the first half of FY22, so looking at typically April to September 2021, against the first half of FY20, which was April to September 2019, so a pre-COVID period of time where the margins are much more realistic, if you like, in terms of the underlying business. So just in terms of headlines on slide 14, revenue was up just over 28% to 102.4 million. Our adjusted EBITDA on the IAS 17 basis, so after a full rental charge, was just over 22 million. That was up 115%. And we saw an adjusted EBITDA margin of 21.5%, which was up 870 basis points. And we'll get behind that 870 basis points in a couple of slides' time. And I'll show you that we've got underlying margin improvement across that period of 40 basis points. And then finally, a profit before tax for the period of 12.8 million. So moving on to slide 15 and looking at our revenue performance and our like-for-like sales. Two charts on this page. At the top right-hand corner, we're looking at total revenue. So that 102.4 million across the 24 weeks. What I've then done is take out the impact of P1, the first 4 weeks of the year for us, where we, as I say, could only trade externally or our sites weren't trading at all. And then I've also removed the positive benefit of the VAT impact. So that was a reduction in the VAT rate to 5% on food and non-alcoholic drinks, which essentially we retained. So those two adjustments give us underlying sales for the 20 weeks, 17th of May to the 3rd of October, of 88.5 million. That's an increase of 32.3% over H1 FY20. And then when you look at that over the period, we've had an average open number of sites of 174 versus 152 back in FY20. So that gives you gross average weekly sales of 30,500 versus 26,400 2 years ago. So growth of just over 15%. And the main driver of that growth of 15% has been the really strong underlying like-for-like sales performance. So we've reported in the first half headline like-for-like sales growth of 26.6%. That includes the benefit of the VAT reduction, which was worth 13%, and taking that out, we've got underlying like-for-like growth of 13.6%. The chart on the bottom right effectively shows the progression of our like-for-like sales performance across firstly the 9 weeks from the 17th of May to the 18th of July. That was effectively the eve of Freedom Day. The second column shows 20 weeks from the 17th of May to the 3rd of October, with the headline 26.6% like-for-like sales. And then the column on the left-hand side shows the full 28 weeks from the 17th of May to the 28th of November. And what you see there across those three columns is, firstly, you see a really strong performance in the 11 weeks, essentially from the middle of July to the end of September. So that key summer trading period, where the performance, as I say, was really strong, very supercharged. And then what you see in the last sort of 8 weeks of that 28-week period is a reduction, and they're coming back to what we see as a much more normal lounge like-for-like sales performance, where historically over the last 5 or so years, we've typically delivered annual like-for-like sales growth of 5 to 6%. Flipping over to slide 16, and this is a really important and a really key feature, I think, of Lounge's performance over the years. And what it shows is a consistency across the different age cohorts of the Lounge's estate in terms of their like-for-like performance. So if you think of that dotted line with the 26.6% like-for-like sales, headline like-for-like sales across the first half, all of those age cohorts are very much consistently grouped around that number. There are 1 or 2 which are slightly below, so for example the FY13 and earlier cohorts, so those are our very earliest sites on the left-hand side. Within that cohort of the estate, we've got some of the earliest sites which are a little bit smaller than the lounges we open nowadays, and therefore more impacted by the reduction in covers and the social distancing rules. The FY15 cohort, for example, also slightly below average, you've got a couple of sites in there that were restricted more by COVID closures and restricted hours. And then on the other side of that, for example, the FY14 and the FY17 cohorts, they include a couple of our really strong performing staycation sites. As I say, though, that consistency of like-for-like sales performance has been a real measure of the lounge performance over the years. Moving on to margin, on slide 17. What I've looked to do in this table is to reconcile the underlying margin of 12.8% that we achieved in the first half of FY20 to the 21.5% margin that we achieved in the first half of this year. And the top half of the table looks at the underlying margin elements, and the bottom half of the table shows the impact of either the closures and the external trading only in period 1, those first 4 weeks of the half, and then the positive impact, most notably, as I said, the VAT benefit, which was worth 780 basis points of margin, and the rate reductions benefit, which was worth 230 basis points. Focusing more on the top half of the table, the underlying margin expansion in the first half across the 20 weeks from the 17th of May to the 3rd of October was worth 40 basis points. And breaking that down, our cost of sales performance, that includes our cost of goods sold plus site labour, that was adverse 60 basis points. And importantly, when you look across the 20 weeks and see how that margin developed, what you see is over the first 8 weeks post-reopening, you see an element of labour inefficiency. We're still incurring additional COVID-related labour costs. It was the time of the pandemic. And then you see, as we get to the middle of July, we take a little bit of price with the introduction of price differentiation, which Nick referred to earlier. And that was the introduction of 3 different price bands across the estate, and essentially taking approximately 3% in price. You then saw a much stronger margin performance over the final 12 weeks of the half. Variable costs were worth 30 basis points to us as we saw improving leverage across the estate. And then most importantly, we saw even more leverage when you think of it in terms of site rent and service charge, where we saw 70 basis points improvement. And typically the business has historically talked about having a site rent to revenue ratio of 6% or lower. And that in itself is a very strong performance. But over the 20 weeks of the first half, our site rent to revenue ratio fell to 4.8%. So the first time it's been sub 5% and a very strong performance. Moving on to slide 18, and in terms of margin outlook. So clearly we were able to develop to deliver margin expansion in the first half against a much talked about background of inflationary pressure. And I think that's evidence of us being able to use both our growing scale and also our ability to take modest price to manage our margins. It's fair to say that I think in the first half we probably saw relatively modest impacts from inflation in terms of food and drink costs. They weren't far out of what we would consider to be our typical experience. Equally though, when we look ahead over the next 18 months and we model inflation out pressures that are out there, we're clearly expecting to see a little bit more inflation. When we think of food costs, we're probably looking at circa 6% of inflation, and drink costs probably circa 3%. So you might be looking at a blended 4.5% or so of food and drink cost inflation over the next 18 months. One project that we have talked about in the past has been our ability as we scale the business and get to approximately 200 sites to start looking at how we can bring added efficiency to our distribution systems and think about moving towards a more consolidated distribution model. If you think about the business at the moment, typically our sites will receive 4 or 5 visits from different suppliers and different trucks on 4 or 5 different days of the week. So a very labour intensive, energy intensive and relatively inefficient model. That, if you like, is at one end of the distribution spectrum. If you think of what might exist at the other end of the spectrum, you've got the likes of a Costa or a Premier Inn, for example, where their sites will be visited in the middle of the night by a single truck, no more than 6 or so nights a week. Clearly, that's a long way from where we are at the moment, but we are commencing a project. We have just commenced a project to start that journey to a more efficient distribution system. There are a number of hybrid models between the 2 ends of the spectrum, which I've just described, and we'll be working over the next 6 to 9 months to work out exactly which of those hybrids should be our first stopping point on the journey. In terms of labour costs, we have a 6.6% increase in the national living wage due in April next year. That's a little bit higher than I guess we've become used to over the years, but we have become used to dealing with typically a 5% increase, and that's been very much the norm for the last 4 or 5 years. And I think we will continue to exhibit a strong track record in dealing with national living wage increases. In terms of utilities, we are hedged with our electricity and gas costs through to September 24, and that was done at May 20 prices. And then in terms of property costs, as I touched on earlier, there's very little upward rent pressure at the moment. And as I say, that rent to revenue ratio dropped to 4.8 percentage points during the first half. Moving on to slide 19 and moving now to cash flow and capex and net debt. In the first half of the year, we generated cash from operations of 29.9 million. That was driven by clearly very strong underlying trading performance, but also the positive impact of those government support measures. And then also the positive benefit of the rebuild in our working capital position. So we benefited from a £9.2 million working capital inflow as the business emerged from lockdown and we rebuilt our creditor balances. Coming off that 29.9 million, there was a Capex cash outflow of 6.5 million. We repaid the 7 million that was drawn down under the RCF, and so we finished the half with 20.6 million of net cash and no drawings under the RCF. Moving on to slide 20, in terms of our Capex performance in the first half. So we had a cash outflow of 6.5 million in the half, as I just referred to. We also had a build-up in our Capex creditor as we restarted the new site rollout programme. So we saw our liabilities to our Capex providers growing by 3.5 million. And that gives us a net spend in the first half of just over 10 million on new Capex. Within that 10 million, there was a new site Capex spend of 8.4 million. And again, getting behind that number, we opened 12 new sites in the first half. 3 of those were effectively completed during lockdown 3 and were in the locker ready to reopen in the half. So essentially, we opened 9 new sites which were built and opened in the first half. And they had a total cost of 7.1 million. So a slightly higher average site cost than we've seen historically, but that was largely due to the fact that those sites included 4 Pizza Express sites, which we took out of the Pizza Express CVA, and those sites didn't come with any landlord contribution. That was part of the reason why the landlord contributions in the half at 675k are a little bit lower than we would typically see. However, we are expecting landlord contributions for the full year to be in the region of 2.5 million, and that will work to bring our average site costs back into line with what we've seen historically. In terms of other Capex over the first half, we spent just under £1 million on maintenance Capex, which represents 1% of revenue, consistent with our spend in FY20. And in addition to that was P&L maintenance spend of 1.9% of revenue, again consistent with where we were pre-COVID. And then finally, the kitchen spend, the introduction of the kitchen screens, which Nick referred to earlier, that was a spend of just over 0.3 million. And then finally, in terms of net debt and liquidity, as I say, we ended the first half with 20.6 million of cash. We have a term loan due to April 24 of 32.5 million, so net debt of 11.9 million as reported. In addition to that, we still have 5.6 million pounds of what I would refer to as COVID-19 liabilities, which are rent and deferred VAT under the VAT scheme. And those deferred COVID liabilities of 5.6 million will be paid out over the second half. So that gives us an underlying net debt at the end of the first half of 17.5 million. And that compares to 29.43 million at the end of the first half of FY20, so pre-COVID. So an improvement in our net debt of 11.8 million. And clearly a major element of that is the £8 million equity raise which we undertook in April 20. But I think most importantly, it shows the underlying strength of the balance sheet. And that is one of the things that gives us the confidence to resume the full new site rollout of 25 sites per year. If I may return to you, Nick.
Thank you. Yeah, so looking at the last slide and us looking ahead with confidence, as we've hopefully set out, that the business continues to trade very well. And if we think about Christmas, I guess the first thing it's important to consider about Christmas is that the lounge business, which represents around 80% of our sales, isn't overly reliant on Christmas. The lounge is a relatively flat seasonally, and the busiest time of the year for the lounge is actually summer. Whereas Cosy Club is more like a typical restaurant business in that respect, and Christmas is important. The 4 weeks of Christmas for Cosy Club represent about 12% of their annual sales. Thinking about Christmas bookings, which is a big part of the Cosy Club side of the business. On the lounge side, we don't take bookings, but on the Cosy Club side, we do. And what we normally see in the run-up to Christmas is the bookings come in a typical year. They start coming in early September. They peak around mid-October, but then they'll continue right through to late November, early December. What we saw this year was that all shifted quite a lot later. So the bookings didn't really start till we were in October. But ultimately, when we look back 10 days ago and looking at the level of bookings that we'd achieved within Cosy Club for the Christmas period, I think we were really happy with how we compared on a like-for-like basis. Thinking about Omicron and the impact that has had, up until yesterday or the day before yesterday, it had very little impact. We hadn't seen any shift in the way our customers were behaving as a result of the variant. I think more recently, in the last 2 days, with the introduction of Plan B, we immediately saw yesterday quite a significant drop in terms or increase in the number of cancellations on the Cosy Club side of the business as a result of that instruction. It'll be interesting to see what happens over the next few days and the next few weeks. Clearly, it's very early and we don't know, and a lot of it will depend on sentiment and nervousness and consumer confidence. I think more broadly, we're optimistic with regards to performance in both brands, as we've hopefully demonstrated by the way that they've traded over the last 7 months. And as Gregor said, our growth and operational discipline meaning we're very well managed, well placed to manage and mitigate most of the inflationary pressure. And as I've said, our new site openings are performing very well. We have an excellent pipeline. And as a team, we believe the potential scale of both brands continues to be very exciting. So that concludes the presentation. We move to Q&A now.
Fantastic. Nick, Gregor, thank you very much indeed for the presentation. Ladies and gentlemen, do please continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. Just while the team take a few moments to review those investor questions submitted already, I'd like to remind you that the recording of the presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard on the Investor Meet Company platform. I'd also like to remind you that your feedback is important to the team, and immediately after the presentation has ended, you'll be redirected for the opportunity to provide your feedback in order that the company can better understand your views and expectations. Nick, Gregor, we have had several questions submitted from attendees today. If I may just ask you just to click on that Q&A tab, and where appropriate to do so, just to read out the question and give you a response, please.
Great, thank you. So the first one from Simon, what are you seeing from a site acquisition standpoint? And what levers do you have to increase sales per site? So I guess taking that in two parts. I mean, from an site acquisition perspective, the position has never been better. It's important, probably just going back to basics a little. We typically convert retail premises. So we convert A1 use to A3. That's the bread and butter of the types of units where we open lounges and Cosy Clubs. And what we've seen over the last 3 or 4 years is as some of the retailers, the demise of some of the retailers has resulted in us seeing more opportunities for us to open lounges and Cosy Clubs. And that was happening pre-COVID. There were lots of retail CVAs pre-COVID. Obviously, as a result of COVID, we've seen more, Arcadia one probably being one of the most relevant. And that means just it's allowing us to secure prime pitch property in really strong target locations where we've been looking for a number of years. A good example would be the St Neots site we opened earlier this year. We opened in a former Dorothy Perkins there. It's the best unit in town for us to have a lounge, kind of combining both the retail pitch within St Neots and the leather pitch, the leisure pitch within St Neots. So from a site acquisition perspective, we're in a really strong place. In terms of levers to increase sales per site, hopefully as we talked through during the slides, we've over the last 6 or 7 years, we've achieved roughly on average 5, 6, 7% like-for-like sales growth, and that's normally been achieved about 1/3 price, 2/3 volume. And one of the great things about trading all day from 9 o'clock right the way through to 11, 12 o'clock is that there are so many different occasions for us to target, for us to innovate, evolve, to get better at. And that's typically where that comes from, where that growth comes from. And if you go into a lounge or a Cosy Club, Saturday lunch or Saturday night or a Friday night, they're very, very busy and they're likely to be full, and indeed Sunday lunchtime in a lounge and Cosy Club. But there's lots and lots of times throughout the week when they're not full. So from a sales growth perspective, it's not a case of capacity constraint. But there's clearly lots more that we can do to deliver quicker, to turn tables quicker, to increase average spend. And we've seen some great evolution from the introduction of the app in the way that our customers are spending more money. And equally in terms of stretch and menu stretch, and introducing more stretch on our menus again to nudge up the average spend of our customers. Looking at the second question from Peter, has management considered offering franchises as a way to expand and dominate the market? I think the quick answer to that is no, we haven't. And I think one of the biggest barriers to entry is, which I think we've seen a couple of businesses try and replicate what we do, big operators, and they've struggled. And the biggest barrier to entry, I think, is the operational complexity of all-day trading. And if you consider a normal restaurant, those restaurants, they take reservations and they have table service. And as a result of that, they can control the flow of orders into the kitchen. And that means the kitchen isn't inundated and the kitchen can deliver consistently. If you think about a lounge, and in a lounge, it's very informal. So you walk in and you either go to the bar or you order a table on the app, but you can't reserve a table. And so the lounges can go from empty to full very, very quickly. And that puts a lot of pressure on our kitchen teams. And equally, they're generating revenue throughout the day. And that can vary quite a lot. And so there's a lot of labor management complexity associated with that. And I think that operational complexity wouldn't work well in a franchise environment, but does suit our managed model very, very well, as hopefully demonstrated by the numbers. Gregor, do you want to answer Michael's question?
I will. So Michael's question, what percentage of revenue do you redeploy per year on repair and maintenance to keep the estate fresh? Is a sharp lounge more productive than an older site? How is this managed? I guess in terms of the headline numbers, we spend typically 1% of revenue each year in terms of maintenance capex, and we'll have another P&L maintenance spend of approximately 1.9% of revenue each year. And I think one thing that really differentiates lounges is the fact that it keeps all of its sites in very good nick from day one, and equally it doesn't have a recurring, if you like, reinvestment cycle. There is no requirement within the lounge business to go back every 4 or 5 years and reinvest in a substantial refurbishment. And I think, certainly when I joined the business, the thing that most excited me was the fact that, and it was back on slide 16 in the presentation today, the evidence of the manner in which we maintain our sites and the very well-kept nature of them is one of the things that delivers that really consistent like-for-like sales performance across all the age cohorts. You see no tailing off in your like-for-like sales just because it's a site which is maybe 10 years old or so.
Thanks, Graham. A question from Matt who's asked, do we have capacity and are there plans to look at a fresh concept or brand without distracting from the existing lounge and Cosy ops teams? In short, well, we might have the capacity, but there are certainly no plans to look at a fresh concept or brand. I think if we look at, obviously, the strategy that we set out at the time of the IPO back in April 2019 was to open 25 sites a year, with the potential scale of the business being 400 lounges and 100 Cosy Clubs. And as we sit here today with 185 sites, I think, we're opening sites better and better, and the availability of property has never been so good. I think our confidence in the potential scale of the lounge brand in particular has grown and grown, and that 400 number looks very, very conservative. And so there's plenty for us to be keeping busy with. And so our focus is very much on fulfilling that strategy.
That's fantastic. Nick, Gregor, thank you very much indeed for addressing those questions from investors. And of course, if any further questions that do come through, the team will have the ability to review those questions and we'll publish responses where appropriate to do so on the Investor Meet Company platform. Nick, perhaps before I redirect the attendees to give you some feedback, I could just ask for a closing snapshot, please.
Yeah, of course. Well, I think Lounges has put in another really strong performance in the first half, and we continue to materially outperform the rest of the market. And as we come out of COVID, both Lounge and Cosy Club have never looked so relevant. We've opened 17 new sites so far this year. The new sites are performing extremely well. We're seeing fantastic opportunities from a pipeline perspective, and the potential scale of the business of 400 Lounges and 100 Cosy Clubs looks very, very conservative. And whilst, yes, there is short-term uncertainty as a result of Omicron, we're very optimistic as we look ahead to 2022.
That's fantastic. Nick, Gregor, thank you once again for updating investors today. Can I please ask investors not to close the session, as you'll be automatically redirected for the opportunity to provide your feedback in order the management team can better understand your views and expectations. This will only take a few moments to complete and is be greatly valued by the company. On behalf of the management team of Lounges PLC, I would like to thank you very much indeed for attending today's presentation. That concludes today's session. Thank you and good afternoon.